the Japanese yen crisis, and the carry trade that's collapsing. The Bank of Japan has been selling dollars non-stop for 2 hours now. The yen has plunged to its lowest level in 40 years, and right now, at this very moment, somewhere between $1 and $20 trillion of Japanese borrowed money is leaving the US stock market. No one knows exactly how much this amount is, but everyone knows that this money is right now in your retirement account and your investment portfolio. If you remember this number by the end of the video, you'll understand why something happened in the US stock market last month that hadn't happened in 22 years. Stick around so I can tell you where that number comes from and why it's the most important news you haven't heard this month. Before I get to the main point, let me tell you something. By the end of this video, I'll reveal a contradiction that even a lot of professional analysts overlook. For those of you who don't want to see it, I have a special offer. Just stay right here, because this contradiction gets revealed right in the middle of the video, and it might completely change the way you look at the stock market. Let's start from the beginning. The Bank of Japan raised the interest rate above 1%. For a lot of people, that's a laughable number. 1%. The US has an interest rate above 5%, but Japan kept its interest rate near zero, or even negative, for 30 years. I repeat, 30 years. That means banks were basically getting paid to lend money. This increase from 0 to 1% in Japan, in terms of its impact on global markets, is exactly like if the US suddenly raised its interest rate from 0 to 10%. Before making this decision, the Japanese government spent more than $70 billion to prevent the yen from losing value. They directly entered the market, sold dollars, and bought yen. The result? Nothing. The yen still fell. Why? Because this isn't a liquidity crisis you can solve with money. This is a structural crisis, and it's called carry trade. Now let me explain carry trade to you with a real numerical example. Not a hypothetical example, but exactly what the big investment funds are doing right now. An investment fund in Tokyo borrows 10 billion yen at an interest rate close to zero. It converts that yen into dollars. With those dollars, it buys American tech stocks, where the annual return is 7 to 10%. At the end of the year, this fund makes about 7 to 10% net profit, without risking a single dollar of its own money. This has been repeated for years, not just by one fund, but by thousands of funds in banks all over the world. And the result has been a massive river of cheap Japanese money flowing straight into American stocks, US government bonds, and even the housing market. When the Bank of Japan raises interest rates, this whole equation falls apart. Borrowing is no longer free. Funds are forced to close their positions, meaning they have to sell American stocks, sell dollars, and buy yen to pay back their debts. And that's exactly what's happening right now. Japanese banks also no longer give cheap loans to foreign investors, because Japan itself now has inflation, economic growth, and a trade surplus. Now it no longer needs to export its money cheaply to the world. Now let me explain the contradiction I promised you earlier. You might think this is bad news for Japan, right? No. For Japanese banks, this is the best news they've had in decades, because higher interest rates mean banks' profit margins increase. Japanese pension funds also had to send their money to America for years, taking on risk. Now they can get the same returns inside Japan itself, with less risk. So at the very moment your portfolio is taking a hit, Japan's economy is getting stronger. This is exactly the part that hardly anyone talks about. And that's only half the story. To understand just how serious this situation is, we need to look at a historical example that's similar to now, but nobody ever mentions it. In 1998, a major financial crisis happened in Russia. That same year, an American hedge fund called LTCM, which was run by economists and Nobel Prize winners, almost brought down the entire US financial system. One of the main reasons for its collapse was exactly this yen carry trade. The funds that had opened huge positions with cheap Japanese money were forced to sell everything at once when global markets crashed. The result? The US central bank had to step in personally and gather a coalition of banks to prevent the complete collapse of the financial system. Cheap money, high leverage, and a moment when everyone wants to rush for the exit at the same time. Now, remember August 2024. A smaller version of the same thing just happened. The Nasdaq market dropped more than 10% in just 3 days. At that time, the Bank of Japan got scared and backed off. But this time, Japan's finance minister has said that decisive action is on the way. This time, there won't be any backing down. Now, let's go back to that number I mentioned at the beginning of the video. $1 to $20 trillion. That range is so huge that even central bank economists themselves don't know the exact number. But here's the point. This is exactly the kind of pressure that made the Nasdaq have its worst January in the past 22 years. What's even more dangerous is that the traditional 60-40 portfolio, meaning 60% stocks and 40% bonds, offers no protection in this situation. Why? Because both of them, stocks and bonds, were bought with that same cheap Japanese money. When that money returns, both markets come under pressure at the same time. So the shield you thought you had doesn't work this time. Alright, now let's talk about the winners and losers in this situation. I'll start with the losers. The main losers are US tech stocks because they were the biggest destination for carry trade money. Highly leveraged hedge funds and American companies that borrowed yen directly from Japanese banks are also losers because now their financial costs go up. First, the winners. Gold. Gold usually strengthens when the dollar weakens and uncertainty increases. Just in the past few months, China's central bank has recorded its largest monthly gold purchase in the last 3 years. Second, emerging markets that benefit from a weaker dollar. Third, American multinational companies like Microsoft and Netflix, because when their foreign earnings are converted into a weaker dollar, they appear higher. And fourth, the Japanese stock market itself, especially Japanese banks, since they directly profit from higher interest rates. Now, let me tell you about the angle that nobody has mentioned. If the US Federal Reserve starts cutting interest rates at the same time as all this, the gap between US and Japanese interest rates will shrink even faster than it is now. In other words, two forces are simultaneously making the carry trade unprofitable. Both the rise in Japan's rates and the possible drop in US rates. If these two things happen at the same time, the speed at which money leaves the US market could be much higher than what is currently predicted. This is a scenario that most common analyses don't mention. So now the bigger question is, if even a portion of these trillions of dollars returns home in the next few months before something bigger happens, how much longer can the US stock market hold up? This is a question that even the US Federal Reserve doesn't have a precise answer to. With that in mind, there are 3 simple principles for this period. First, avoid positions that are heavily dependent on non-stop tech growth and have grown with cheap money. Second, stay away from leverage and margin during this period, because it's exactly these kinds of fluctuations that hit leveraged accounts the hardest. Third, identify assets that benefit from a weak dollar. Not because they're going to go up tomorrow, but because of the economic logic behind them. I'm not a financial advisor, and this isn't investment advice. I'm just explaining the market mechanism so you can make better decisions yourself. So, let's sum it up. The yen is at its lowest level in 40 years. The Bank of Japan has raised interest rates for the first time in 30 years. A river of money, somewhere between $1 and $20 trillion, is slowly flowing back home. And that's exactly what's behind the worst January for the Nasdaq market in the past 22 years. History, from the 1998 crisis to August 2024, has shown us how this mechanism works. The real question isn't whether this will happen. The question is how long it will take and how many people are prepared. If this video helped you understand this complicated story in a simple way, just let me know with a like. And if you want to see the next part of this series next week, where we'll take a closer look at exactly how the gold market and emerging markets reacted, subscribe to the channel right now, and don't forget to like.